The Kevin Warsh era has just begun, and he held his first Federal Open Market Committee meeting just recently. And the Fed decided to hold rates. So, what does this mean for our investment portfolios? Does it mean that the sky is falling? We're all doomed? Or does it mean that our investment portfolios are going to grow straight up and to the right, take off like a rocket ship? Let's gather around and talk about it together and see what it all means for our investment portfolio and our financial abundance.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Hey everyone, welcome to another episode of Secrets to Abundant Living. Oh, it's so good to see you all here. I'm recording after just getting back from the Huntington Library and Gardens with my dad for Father's Day and my mom. It was so much fun. If you're ever out in the Pasadena area, it's technically San Marino, but it is a gorgeous and beautiful place to visit. You need reservations if you go on a Friday, Saturday, or Sunday, but if you go during the week, you can just waltz right in and have a lot of fun with all that there is to watch there. My favorite area is probably the desert garden. There's all sorts of succulents and beautiful plants and flowers to take a look at. So pretty. Well, okay. My name is Amy Sylvis. I forgot to introduce myself. I'm the founder and CEO of Sylvis Capital. We help connect investors to hands-off commercial real estate investment opportunities to diversify portfolios, diversify income sources as a hedge against inflation, all of those great things. But we're here today on this solo episode to talk about financial abundance. And as a reminder, and I know you all feel the same way, but I just like to say it out loud, our wealth is not the destination. It is a tool. It's simply a vehicle so we can give abundantly to others that need our help in our community, so we can plan for the future and for a safe, secure retirement, so we can enjoy and own our own time, so we can spend time with our loved ones, build those relationships, and of course, enjoy hobbies, et cetera, et cetera. So let's talk about this vehicle today. And the Federal Reserve, as we mentioned, has a brand new chairman. His name is Kevin Warsh, and they just held their first meeting. And these meetings happen several times a year. They're called FOMC meetings, Federal Open Market Committee meetings, where they do several things. But the most important to most people is, what's the Federal Reserve interest rate going to be? And at this time, they decided to hold interest rates steady. So yes, some people may be saying, well, wait a minute, I wanted the rates to be cut. And other people may be saying, oh my gosh, inflation is higher. Why didn't they raise? Well, look, they held them. So that's where we are. And we can kind of talk and speculate about what may happen next. But that is where they are as of today. But I'd love to talk about what that means for our portfolio. Obviously, my expertise is in commercial real estate, so we can talk through that as well. But there's also some nuance about the Federal Reserve interest rate as well that I'd love to talk through. So, all right, we're going to try to make this as not boring as possible. I know interest rates in the Fed is probably not something that you're jumping for joy to hear about, but we're going to make this interesting because it's your wealth and it matters. So we're going to talk through that. But the first thing I really want to make sure to cover is this idea of, what is the Federal Reserve's interest rate? What does it mean? And as a reminder, you all probably know this, but as a reminder, this is the interest rate. It's a very, very short-term interest rate at which large banks lend to each other overnight. So this isn't the rate at which you pay for your car loan, or you pay for your house mortgage, or we pay as commercial real estate investors. That is determined by a bunch of other things. But in some cases, and we'll talk through this, it can influence those other interest rates. But I'll give you a preview. There's been a little bit of a decoupling, which is really interesting. So, what the Fed is doing isn't necessarily having the kind of one-to-one correlation or influence that it has in the past. So, we'll talk about why that even matters as well. Oh my gosh, get excited, y'all. I had someone reach out to me, and this is kind of the genesis of the podcast, that asked me what I thought about what the Fed kind of, said, or what their move or lack of move is, and how that was going to influence what I was telling my real estate investors and my real estate portfolio. So I thought, oh, what a great question and a great opportunity to really talk through how we see this. So on the commercial real estate side, you may have heard the Fed may be keeping interest rates higher for longer. And, this is consequential because, and we'll talk through this, but there is a relationship in the commercial and single family home space and the Fed funds rate. But historically speaking, and we need to keep this in mind, where the Fed funds rate is right now is historically not high. It's not historically low, right? We're not at COVID levels where it's almost zero, but we're not in the double digits that we've seen in the past. So historically, this isn't really a high interest rate period, but higher for longer. So higher than where we were before, right? So I guess that's a fair term. As a reminder, interest rates, the Federal Reserve interest rates basically tripled since 2022. It's since come down a little bit, but I guess that's the higher for longer folks are talking about. But I do want to just visit this idea of, yes, that may be the case where the Fed doesn't cut, where maybe folks have been looking for them to cut, but don't shortchange the fact that the midterm elections are coming. And goodness, if the Fed, I know it's supposed to be apolitical, but don't forget the Fed cut 50 basis points in September of 2024, right before the election. It was 6 weeks before the election. And we've got midterms coming up. And we also have a very, very large national debt, $39 trillion and counting. And some of it needs to be refinanced here in 2026. So look, my crystal ball is as good as yours, and I understand what kind of the majority of people are saying with regards to interest rates, but you never know what Warsh has up his sleeve. And again, I know he's just one person out of the Fed Board of Governors. But anyway, I won't digress too much. But let's just say that the Fed is going to keep interest rates steady, maybe raise a quarter point or 50 basis points in the future. How does this actually impact real estate, specifically commercial real estate? Well, let me tell you, in the commercial real estate space, or even your single family space, car loan space, none of us are borrowing money for debt at the Fed funds rate. In the commercial real estate space, fixed rate debt, mainly from Fannie Mae and Freddie Mac, is based on the 10-year Treasury. And historically speaking, the 10-year Treasury followed what the Fed funds rate did. Obviously, they weren't identical, but if the Fed funds rate was cut, 10-year Treasury would go down. That hasn't been happening. So this is the first point I want you all to take into account, that just because the Fed held interest rates, that doesn't mean the 10-year Treasury, and therefore the interest rate at which we borrow money in the commercial real estate space, is unchanged. So let me give you an example. I mentioned back in September of 2024, the Fed cut interest rates by 50 basis points. Guess what the 10-year Treasury did? It went from 3.65% to 4.3%. How does that happen? How does that happen that the Fed cuts rates and then the 10-year Treasury goes up? Well, the 10-year Treasury is open market. It's free market, right? It's not necessarily set by any sort of government agency. Now, can the Fed influence that? Oh, you betcha they can. You may have heard of something called quantitative easing. But all I'm trying to let you know is just because the Fed cuts rates or the Fed raises rates, that doesn't mean that the 10-year Treasury and therefore the interest rates that we pay in commercial real estate stays the same. Okay, so that's the first piece of the puzzle I want you all to keep in mind. It's just because the Fed cuts rates, that doesn't mean that the interest rates that we pay in commercial real estate go down. Now, again, as I alluded to, the Fed has other tools to make interest rates, to make the 10-year Treasury go down, like quantitative easing. But we're talking just about the Fed funds rate and what they have that set at. Okay, so you may be asking, well, Amy, okay, so if we have interest rates that remain steady, is that bad for commercial real estate? And my answer is, well, not inherently, no. Look, there's a lot that goes into commercial real estate investing and strategy. So let's unpack that. Again, hang in there with me. I know this isn't the sexiest topic today, but hopefully because it has to do with your money and you're interested in learning about commercial real estate, you'll be invested in this. So invested, pun intended. In commercial real estate, you can have fixed or variable rate debt. So for those who, for example, bought properties 4 or 5 years ago that has variable rate debt, and the debt that they originally purchased a commercial real estate property with, now it has tripled. Yeah, that's a problem. That's not going to be a good time. But for those who have fixed rate debt for 5 years, 7 years, 10 years, there really isn't much of a consequence in and of itself. Yeah, if it's 5-year debt and you purchased a property 5 years ago, your interest rates have tripled. That's a problem. But if you have 10-year debt and you purchased a property 5 years ago, you still have 5 more years and maybe you sell the property before then. So there are a lot of moving parts and a lot of variables here. So the education I'm giving you all, I'm trying to parse that out as much as possible so I can be your guide in how to think through this. So if we bought a property a year ago at fixed rate debt, or we refinanced a year ago, the 10-year Treasury is essentially close to the same. So the fact that the Fed hasn't cut, that's not going to negatively impact a property per se. Again, all things equal, that we bought a year or two ago. That's just not how that works, especially if the debt is fixed rate. That's the caveat. If we have fixed rate debt on a property we purchased a year or two ago, all things equal, the Fed keeping interest rates the same, not really consequential. Now, what about on the investing side if we were to buy a new property right now? Look, it is simple math in terms of what can work, what interest rate works, and what purchase price works for the net operating income of a property. So does that make it a bad time to buy right now? It's only a bad time to buy right now if you're paying too much for the property. But my goodness, I would argue that that's true whether interest rates are super low, that they're medium like they are right now, or whether they're super high. It's really important to buy at the right price. We just have to match what the interest rates are, which we can't change, right? We have no influence over that, but we do have influence over the purchase price of the property. And once we own the property, the other thing that we have influence on is the net operating income. How well are we running the property? Are we able to charge higher rental rates to increase our revenue? Or are we able to control expenses better and make sure that we have adequate negotiation power with insurance? Are we able to increase operating efficiencies by hiring a great property management company that's able to control costs? And there are some costs we can't control, right? Insurance, some would argue, is a non-controllable, but we can negotiate. We can make sure we're buying in an area that doesn't have as volatile insurance rates. We can also make sure that we're properly evaluating and keeping enough reserves in terms of cash for operating expenses and capital expenditures when we evaluate and underwrite a property. So lots of ways that we can control what we're doing in the commercial real estate space. Again, to be able to generate cash flow and have successful investments to be able to grow our wealth for our financial future and our financial abundance. But again, having fixed rate debt that's longer term can help us really hedge our bets and mitigate risk. When we're projecting, we do what's called underwriting before we purchase a deal. We can project that insurance and utility growth is a little bit higher than we normally would. It seems like we might be in a higher inflation environment right now. So that might be something to consider. Again, having ample reserves with operating reserves, operating expenses, as well as capital expenses. And there's also something called a cap rate. So if you all aren't familiar with that, a cap rate is the property value is the net operating income divided by the cap rate. So cap rates are generally tied to interest rates. Investors demand a higher cap rate to justify taking on risk. So when we're underwriting a property, we can make sure that we don't project that cap rates go down. We can project that they stay steady or maybe even slightly go up. This is another conservative layer when we're underwriting to make sure that we're not taking undue risk and we're mitigating risk as we're evaluating an investment. Okay, so I mentioned fixed rate debt that is medium to long term in terms of duration, assuming zero cap rate compression, meaning we're not going to assume in our underwriting that cap rates are going to go down. We're going to have more aggressive projected insurance and utility growth because we might be in a more inflationary environment. To be determined, I'm not sure if the inflation numbers that we've seen recently are just due to the Iran war and those will go away, or if they aren't, if they're just part of a more systemic inflationary environment. And maintaining higher reserves, as I mentioned. So all of those are within our control when interest rates aren't, but we can keep control over that and follow what many people have done in medium and even high term interest rate environments, which is buy and operate very profitable real estate investments. And again, you can do this on your own. This is something you can do on your own by yourself, or you can invest alongside other people in a fund or a real estate syndication. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. And this really comes back to why education is so fantastic, because I get the idea of applying a single family home or single family real estate mentality and imposing it on a commercial real estate mentality, right? So you may be thinking, oh gosh, well, okay, single family, if I buy a house and interest rates are high, I'm going to be paying more. And then, I only make a profit when I sell it. It could not be more different in the commercial real estate space because, again, we're cash flowing these properties, right? So we're making money not just when we sell the property, and it's not a flip, right? This isn't something where we turn around a year or two later, but our cash flow, as long as we purchase correctly, and that is completely within our control, our cash flow isn't influenced by interest rates if we have fixed rate debt. So we're still making money in the cash flow. Your single family home property that you're living in isn't a cash flow machine, right? It's a different thing, unless maybe you built an ADU on it or something, but then it's no longer single family, right? So I guess the idea here is I just want to make sure everything has risk. Every sort of investment has risk. The stock market has risk, especially when it relates to interest rates. But in the commercial real estate space, what I personally love about it, and again, not investment advice, it's just my perspective and my lived experience here. So this is just for education. But there are so many levers that we can control, even though everything isn't within our control. The Fed keeping interest rates steady and not cutting doesn't mean that the property we bought a year ago is not going to do well, because we bought it right and we have the proper reserves, conservative underwriting, and we have fixed rate debt. And the same with acquisitions moving forward. If we don't underwrite and plan on interest rates going down in order for the property to be profitable, or if we don't plan on, again, interest rates to be cut, but we have proper reserves, all of those things, right, that we talked about, that's where it really can get good. And we can do quite well as investors in a medium interest rate environment. I'm not going to say high because historically we're not at high interest rates, but a medium for longer interest rate environment. So hopefully you all survived that. It wasn't too dry. We got through it and you got some education and understanding about how to think through this time right now. Hey, if the Fed cuts rates and the 10-year Treasury follows, right? That's not always a guarantee. But if the 10-year Treasury goes down, sure. I mean, would that, all things being equal, make the investment more profitable? It may. It may. But if it skyrockets inflation, that's another thing, right? Our expenses go up. So again, the key as an investor in real estate is to understand what's within our control, what isn't within our control, and making sure that we tightly control what we can to position ourselves to mitigate as much risk as possible. And that's why people who've been successful in real estate will tell you the exact same thing. And they've made generational wealth in such an exciting and fantastic asset class. While, and my belief is, because I've lived this, making a difference in our residents' lives, caring about them, providing safe, secure, clean housing, making a positive impact on the surrounding community. That's what it's all about. And it doesn't have to be an either or. We can do well for ourselves financially and do well by people. All right. Well, thanks for joining today. I look forward to your feedback. Hopefully you all found this helpful and educational. If you did, what would be really helpful is if you went to Apple Podcasts and you wrote a review. So you can go to the Secrets to Abundant Living podcast, scroll about halfway down. There'll be a little button in the middle where you can say, write a review. That would mean the world to us. Yeah. Well, thanks for joining. I look forward to seeing you all on the next episode. Bye for now. We'll talk to you soon.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.